Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Helen Mattison. Today, as we look forward to the Easter break, you might be off to the warehouse for some chocolate bargains. And if you are, that spending will certainly be welcomed. The Warehouse Group has described its half-year results, out just last week, as sobering. This is off the back of declining sales, the write-down of Torpedo 7, and plans to exit the Market.com business. To unpack the numbers and find out how the Red Shed plans to weather these tough times, I'm joined by Warehouse Group Acting Chief Financial Officer Celia Mearns. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Celia.
Morning.
Great to have you on the program today. Listen, before we get into the numbers and the results out last week, let's think about your background, when you started at the warehouse and why you joined.
Yeah, really great question. Thank you. So I've been with the warehouse now 3 years actually this month, and have been in the business predominantly as a finance director within the finance team. I've held a number of CFO roles, both in retail and actually in the wine industry previously. So I was really keen to join the warehouse to be part of the largest retail general merchandise retail business in New Zealand, and it actually holds a special place for me. I worked for the warehouse 30 years ago as a much younger person, and the finance team in this business actually inspired me to go and get my degree and become qualified. So it's kind of a nice coming home really for me as well.
Sounds great. Now, before we do jump into the numbers, I'd like to remind listeners of what the core businesses units are for the warehouse. I mean, we've got the warehouse, which I think of as variety, we've got warehouse stationery, and we've got Noel Leeming. Are you able to explain just where the revenue split is? In other words, what percentage, if we looked at a pie graph, would you have?
Yeah, sure. So the warehouse is about 60% of our sales. Warehouse stationery is about 7%, and the balance of around 33% is our Noel Leeming brand.
Looking at the results, obviously then the loss, and that was obviously due to Torpedo 7, so the write-down made that 23.7 million, I think. That write-down was about 55.5 million. That obviously has changed the results somewhat. So what can you tell us about that?
Yeah, and obviously during February we announced that we had sold Torpedo 7, and we actually sold it for $1. Now, as part of that, and the result of that is that we have a significant write-down of the inventory and assets related to that business. So that's essentially what's generated the $55 million loss, is the write-down of those assets.
So if you look at the net profit without that write-down, how does that fare then?
Yeah, so net profit before, and what we like to call, I guess, continuing net profit after tax for the rest of the business, excluding Torpedo 7, is a profit of 30.7 million. So that's an increase of around 19% on the year before. So the actual underlying core businesses have actually done okay, especially in light of the economic conditions at the moment. Certainly as part of that, we've seen an improvement in gross profit, particularly in our red stores, which was a focus for us after year end, and a significant focus on our cost of doing business as well.
Just Celia, just on that gross profit, just to explain, that gross profit I think is when the business costs are taken out, are subtracted from the profit, so that's the services and the products, if you like, is that right, the cost of doing business?
Yeah, so our gross profit is essentially our sales less our products and the cost of getting those products to market. And then our net profit is once we deduct also our cost of doing business. So it's paying all the staff and all the associated costs of our stores.
Now, if we look at sales, they are down nearly 5%. I mean, there's no secret that retail is doing it hard. We've had mixed results, I suppose, in the sector. We've had KMD had forecast a loss, and that came in the other day. But then you've got Briscoes, who have actually done pretty well, all things considered. What would you say is behind that lower sales? I think in your commentary you talk about online being a bit of an issue there.
Yeah, so when we look at our same-store sales, which is when we take out stores that have closed or stores that have opened during the year, so we're comparing the same like for like, if you like, stores that were open last year and this year. And also if we exclude online, because we can talk about that a little bit separately, our actual same-store sales were down only about 1.4%. Our core retail stats at the moment say for that period we were down about 2.2%. So we're actually, the actual sales themselves we're okay with, but, obviously realistic that it is a challenging time at the moment.
Also, one thing that came out with the announcement was the market.com. That's a e-commerce platform that you've had, I think, for about 5 years, but you've said you are going to exit that at year end. Tell us why that's happening and, what were the losses in the end?
Yeah, so I think, a couple of different comments to make around the market. The market originally was something that we developed as a marketplace to sell third-party brands as well for branded suppliers. And part of that was because those brands at that time, it was easier to have them on a sort of more of a neutral branded marketplace than to have that associated with the red stores and the warehouse. That has sort of changed, I think, over the 5 or 6 years since that business was first created, and it's actually easier for us to have those products available, and it makes more sense for us to simplify our business and have those products available on our red warehouse website. The market itself took quite a bit of investment to generate the organic growth that we were looking for, and the reality is it just didn't meet our growth targets, in total.
Was that partly because of the competition with the likes of Temu?
Yeah, Temu's an interesting sort of proposition at the moment. We know they're putting a significant amount of investment into their sales, and it's also, I guess, from what we can see, is a platform that sells products that probably don't live up to the same product quality and standards in terms of supply chain, etc., than what we are sort of ascribing to.
So, Celia, if we think about the marketplace then, which I think is the online platform or e-commerce vehicle, if you like, that you'll now be focusing more on, what was the difference between that and the market.com?
Yeah, so the market.com is on its own website. It's obviously branded the market, and our website, the warehouse red website, is essentially our warehouse store website. So when you go into that website or on the app, you can actually look up products, and some of those products will be from third-party suppliers as well as from us in our stores. So it's essentially just the front end in terms of where customers go.
If we look at the strategic reset, which I think Joan Withers, your chair, talked about when the results came out last week, she talked about sort of getting back to the core business. We mentioned those at the beginning, stationery, warehouse, general, and of course Noel Leeming. What does it look like getting back to the core? What will customers see? What will investors find out?
Yeah, so a lot of that work has been done in the background, I guess, in terms of improving our infrastructure, creating where we've had different systems in the background operating those different brands. We're trying to combine and simplify in the back office. So some of that may not be so visible for customers and for shareholders, but should certainly create efficiencies for us within the business. From a customer-facing perspective, I guess the focus for us is around getting into our products, understanding our customer needs, and creating great value for our customers, focusing on essential ranges, etc., through grocery and through our other general merchandise products. You
mentioned grocery there. That was a bright spot. Among sort of the darker ones, I suppose you'd say. I see that was accounts for about 20% of sales. That's obviously going pretty well, although I did see the CEO, Nick Grayson, say that he wouldn't want it to go beyond 25%. Can you explain the thinking behind that?
Yeah, so for the warehouse, we very much see grocery as complementary to our general merchandise business. And really the focus is on everyday essentials, providing value for Kiwis and for our customers, and things like, butter, cheese, eggs, all of those things that we think are, really important for our customers, particularly in this current economic climate, to have as affordable everyday essentials. So our main focus for grocery is around providing that those everyday basics.
So you're saying to me that the likes of cheese, which a lot of people have cried saying that it is too expensive, but it is a staple, would be somewhere you'd go to the warehouse for that?
Absolutely, yeah. We've certainly got cheese, butter, milk, flour. We have our the Market Kitchen brands where we're really endeavouring to source, great value basics like rice, flour, peanut butter and more products all the time into that basic pantry range.
I also see that Tony Carter has joined the board. He's the My Food Bag chair, and he has a background in supermarkets. Does that obviously kind of shore up that positioning and the direction for that part of the business?
He's definitely got some great grocery experience, obviously, through foodstuffs and his My Food Bag experience. Tony Carter's a very experienced director more broadly, has owned some Mitre 10 stores and certainly has that general merchandise, skill set and experience as well, which we'll find very valuable for the business.
Now, Celia, the subdued consumer spending is everywhere. We've been talking about it for many months, and it looks like it probably will continue for a while. What's the warehouse thinking in terms of that? I see that you haven't given an outlook. You will give a trading update for the third quarter, but it does appear that things are pretty volatile, so that's probably why you aren't giving any forecast at this stage. But what does someone like the warehouse, the biggest retailer in New Zealand, do when things are like this? Where's the resilience that you have, and the faith that investors perhaps can have that you have a strategy, given that these times aren't going to be over quickly?
Yeah, and I think certainly all retailers are focused on cost of doing business, ensuring we can get the best value products, for our customers, and products that really resonate with our customers. Our key thing is about making sure that we can provide the value, the everyday value that our customers want, and at the right price and with the right cost. So from a shareholder perspective, really getting the cost down in the business is important, managing our working capital, managing our cash, etc. And as times dictate, when things are a little bit tougher, you certainly manage your investment levels, etc. as well. But key for customers really is around us providing those products at great prices.
Is there more headroom to reduce operating spend? I know some analysts have talked about there being some. I'd like your perspective on that.
Certainly, there absolutely is, and we're certainly continuing to work on that and to look at that. We had started to reduce our cost of doing business significantly post-COVID in H2 of last year. So we know that this half, H2 going forward, is probably going to be a little bit harder to get as much cost down. Certainly in the first half, we've reduced our cost of doing business by 1.5%, and we do believe there is more that we can pull out in the second half.
How will you do that then?
Lots of different ways. So, part of that is around, as we talked about, the platforms. We've got an ERP FI system about to go live next month, and that's about simplifying, process and behind the scenes, and trying to reduce costs through that simplification process. And then, as I said, reducing some of our project expenditure, investment, etc. That does hit our results, our P&L.
What are you noticing with consumer sentiment? I mean, it has been down, it is subdued in terms of sales. Does that mean people start sort of focusing on the basics, like you've talked about, the cheese, the butter, the eggs?
Yeah, definitely. We've noticed across the brands, and we obviously had Noel Leeming and Warehouse Stationery as well as our Red stores, that customers are very purposeful about their shopping. So they know what they want to get and they're coming in to buy that. So it's very much about making sure we have product there available for them at the right price so that they choose us for those very purposeful purchases that they're making, given the reduction in people's wallet and available spend.
When a company reduces debt and then has a bit more happening on the balance sheet, they often then think about what growth opportunities there are or what other potential the business might have. It does sound like at the moment you're getting back to the core and you're focusing on cost reduction. Is there anything that you are thinking about? Surely a business like the retailer that you are would always be looking at opportunities regardless of the climate.
Yeah, it's quite funny. In the investor session that we had last week with our half-year results, Joan Withers, our chair, said that when asked this question, she said she would never say never. And, I think at the moment, the key focus is on our core business and making sure that's as strong as it can be. Obviously, opportunities come up all the time, and if something did come up, we would definitely, sort of closely scrutinise that to see whether it was something that would fit and that it would be worthwhile doing. But yes, you're right. At the moment, our focus really is on that core business.
Looking back at sales again, and online sales in particular, if we can pick that up, they did obviously dent the sales figure. Well, it would appear from the commentary anyway. What's behind that? Is that themarket.com, or how would you describe it?
Yeah, definitely is. At least half of it is absolutely from the market, and you would see in the investor presentation that the market made a loss last year of 16 million. This year it has made a loss of just over 5 million, but part of that is actually about writing down the front end of the website for reasons we've talked about around considering what we do with that, with themarket.com. But certainly, those sales that we were, chasing last year, there was a significant amount of marketing and advertising going into generating those sales. And so some of that it has made sense to walk away from, and actually made sense to purposefully dial back our online sales where they're not profitable. So essentially, we've improved our profitability by reducing some of those sales that were not profitable.
What's the kind of quirks with online sales? I mean, compared to in-store, what have you learned? I mean, e-commerce has been around many years now. It's obviously something that retailers need to have both. Is there a sweet spot when it comes to percentage of online compared to in-store?
Yeah, it's a really difficult one to answer, because we do recognise that our online presence actually also generates sales in stores. There's definitely, customers that will look online, maybe not make that purchase online, but they will go into store and make that purchase when they can touch it, hold it, and walk away with it at the same time. So yes, there definitely is a sweet spot. Definitely is about getting the supply chain and the fulfillment processes right around online, but also we understand that a lot of our customers do want to come into store and and look and feel the products before they buy them.
Thinking about cost reduction for a moment too, and efficiencies, automation, that kind of thing. What about AI? Surely the warehouse is right across that, and it's a part of your business, and that could help with automating cost reduction and the like?
Yeah, definitely. It's certainly something that's top of mind. Our CEO, Nick Grayston, is certainly driving that himself, and our new CFO, due to join us next week, I understand has done an MBA in AI and in related technology. So it's certainly going to be something that the business focuses on. Certainly AI for our business is, a lot of that is around data, either data processing or using it to help us, streamline supply chain efficiencies, etc. So definitely looking into where and understanding customer data as well. So definitely AI is a feature that we're looking at.
What about marketing and ad spend, I mean, that always seems to get chopped when times are tough. However, someone like the warehouse would probably do a fair bit of that. I mean, how has that landscape changed?
Yeah, I mean, we're certainly, as we talked about with themarket.com, we've certainly reduced our marketing spend where it didn't make sense for us to invest in those areas. But for us, marketing generally and advertising and promoting the products that are available is still a really important part of our business. So not significantly reducing that at this point. It's important for us to maintain that.
So you're not going to change the jingle then?
We're always looking at different ways to represent the brand.
That jingle has been around for, feels like decades. Is that right?
I can remember it from the early 90s at least, from my first time round of being in the business. But I think it's become less, it was pretty in your face to start with all those years ago, and I think it's probably softened over time. I think the key thing for us really is about reinforcing that the warehouse is somewhere where everyone can get a bargain, and that's something that we still want to keep in the hearts and minds of our customers.
Celia, what about the Noel Leeming business? I see that sales there were down, but it does feel like there's strength there, and possibly that is kind of a bright spot too.
Yeah, I mean, our Noel Leeming business has performed pretty well, all things considered in the current climate. Operating profit was $14.3 million for this half year, which is a pretty good result for them. Really what we're finding is that customers are still buying, the essentials and things that they need to around appliances, etc. Again, customers are very purposeful around their purchases. They're coming in, and looking for particular things, and also highly driven by promotions and sales. So for Noel Leeming, that is important around our major trading timeframes, Black Friday, Christmas periods, Boxing Day, etc.
Now, if we look at stationery, I think at the beginning you talked about it being 7% of revenue, so quite a small aspect. Is that declining given everything is going online? I mean, there's different aspects of stationery as well.
No, our warehouse stationery business is actually a great little performer. It's a profitable business and continue to be profitable. It's softened in some areas post-COVID where, everybody's filled their homes with their home office equipment and things that they needed over that time. But certainly our print and copy businesses and other aspects of stationery have actually performed pretty well. It's a solid part of our business, and certainly one of the higher gross margin parts of our business as well.
I suppose that's where you go to get things printed these days.
Yeah, definitely. And we still have some standalone stores, but we also have what we call our store within a store concept, where we have warehouse stationery stores within the warehouse, which makes it super convenient for people to come and do that. Print their photos or print whatever they want to print whilst shopping within the Red store as well.
Just looking at the next 6 months, in terms of what investors need to think about, what would your message be? We have a dividend of 5 cents.
We didn't pay a dividend, an interim dividend last year. We certainly felt at the time that conditions were pretty unstable coming out of that COVID environment. But we felt it was important to pay a dividend this year off the back of the profits that we've made, the cash profits that we've made in the business, and obviously in light of our debt position, etc., working capital positions. So directors felt that it was important to provide that for customers as a return on their investment.
Yeah, the headwinds still seem to be there. The macroeconomics aren't going away, and obviously that has an effect on consumer sentiment and discretionary spend, which is pretty important for the warehouse group. What do you see happening in the next little while? I mean, you can't give a forecast, but it'll be just sort of nose to the grindstone, will it, for the business, and investors really just need to wait and see?
We'll definitely provide an update for Q3 in May, so that'll be the next point that we can provide an update on how we've gone. Certainly, February was a pretty rough month, I think, as everybody was recovering from Christmas, paying down their credit cards, etc., and certainly we were cycling over a period last year which, where people were the floods and things, had affected how people were sort of purchasing, replacing assets and things last year. So, February has been softer this year. March has settled down a little bit, but certainly Q3 we will be able to provide our next update. From our perspective, obviously, from what we've communicated already, it is a cautious outlook, certainly from a retail perspective.
Celia, we've gone around the houses today. Good to get an overview of what's happening with the warehouse, and obviously everyone in retail is hoping that things will be better, particularly staff, I imagine.
Yeah, absolutely. The team's doing really well. Our store teams are always enthusiastic and always delivering. We're really proud of our team, proud of our support office team as well. Everyone's working pretty hard to make sure that we can really source those great products and get them out to our customers. So no, we're in good heart and up for the challenge.
Okay, so it's watch the space. Thank you, Celia, for tuning in, and thanks everyone for joining us today. You can watch Shared Lunch on YouTube or follow the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a rating and comment about what you'd like to hear next. We have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch2024, all one word, you'll get $100 off an annual subscription. The offer only applies to new BusinessDesk subscribers, can only be used once per subscriber, and can't be used with any other discounts. Enjoy your Easter.